Welcome to the deep dive. This is where we take your sources, research notes, all that stuff, and really try to pull out the key insights. Today, we're diving deep into monolithic power systems, MPWR. We've got a detailed report here, and well, our mission is to unpack it for you. Find the most important bits, give you that shortcut to understanding what really makes this company tick. Separate the hype from what's actually going on. Okay, let's unpack this.
Absolutely. And the core question we're trying to nail down here is, fundamentally, is MPWR a high-quality business? And if it is, what are the key things shaping its future? And how is the market looking at it right now? What's really fascinating, I think, is how you can look at different metrics, different angles, and get, well, surprisingly different pictures of the same company.
Right. Let's kick things off with growth then, because the report, it certainly paints a picture of, well, an incredible run for MPWR historically. Can you walk us through that? What was the pace, say, between fiscal 2020 and 2024? And what was really driving that?
Yeah, you're right. It was an extraordinary period. Between FY20 and FY24, the revenue grew, on average, over 30% a year.
Yeah.
That's genuinely sector-leading stuff for a company that size. It was really fueled by just broad demand, digital transformation speeding up everywhere, plus they were gaining significant market share.
But it wasn't just a straight lineup, was it? I remember seeing a noticeable dip in 2023. What happened there, and how did they bounce back so fast in 24?
No, you're right. It wasn't smooth. Growth actually slowed way down to just 1.5% in FY23. That was mostly because of that big inventory correction across the whole semiconductor industry. Customers overordered during the pandemic boom, then had to work through all that extra stock. But MPWR showed its resilience. They bounced back really strongly in FY24 once that correction started to ease up.
Okay, so does that slowdown mean they're hitting a ceiling? Or is it just, the law of large numbers kicking in as they mature? What's the outlook for growth looking like now?
It's definitely more the second thing. They're shifting gears, moving from that like 40–50% hyper growth we saw before to something more moderate, but importantly, still really robust and sustainable. Our forecasts for FY25 through 27, they show revenue kind of settling into the mid to high teens, specifically about 18.23% average growth forecasted. And this slowdown, it's not weakness. It's just a natural evolution for a company getting bigger.
That makes sense. And building on that, the report points to where they see future growth coming from. What are those main engines going forward? Because here's where it gets really interesting for their long-term story, right?
Absolutely.
Yeah.
Their future growth is really anchored in these high-value, long-term secular trends. We're talking specifically about more and more semiconductor content going into electric vehicles. That's their automotive segment.
Right.
And also the huge power management needs of AI data centers. That's their AI-driven enterprise data business. These are just massive tailwinds.
Okay, but focusing like that, it sounds great, but there's always a flip side, isn't there? What's the main risk the bears, the skeptics, point to with the strategy?
That's exactly it. Concentrating like that ties their fate much more closely to the spending cycles in those specific industries. Right. If EV adoption slows down or AI data center builds pause, even just for a bit, MPWR could feel that impact more sharply than others.
So pulling it all together on growth, the report gives MPWR a strong 4-star rating. That's a 4.20 score. What really stands out, I think, isn't just the past growth, but the strategic shift. Moving from broad capture to really zeroing in on AI and EVs, it feels less like just expansion and more like a plan for staying relevant long term.
Yeah, but it's really crucial we add a little nuance here about the historical numbers, especially for FY24. Their net income and EPS growth rates for that year look huge, but they were significantly inflated. There was a big one-off tax benefit, over $1.2 billion. So while those numbers jump out, looking at EBIT growth, earnings before interest and taxes, that gives you a much more, let's say, normalized view of how their actual operations expanded historically, a truer picture.
Okay, good point. Let's shift then. From growth to profitability. The report basically calls this the cornerstone of their strength.
Yep.
Why is their profitability so good? What's the secret sauce there?
It's genuinely exceptional, and the why really goes back to their unique business model. Highly integrated. Their whole founding idea was revolutionary for the time, putting an entire power system onto a single chip. This gives them, well, superior pricing power and operational efficiency that most competitors just can't replicate easily. It's not just a small edge, it's a real, durable competitive advantage. A wide moat, you could say.
And do the actual numbers back that up? Can you give us some examples, like Gross margins, operating
Well,
margins.
absolutely. Look at gross margins. They've consistently kept those in the mid 50% range. The 5-year average is 56.4%.
Mm.
Now compare that to the semiconductor industry average, which is usually, 40, 50%. So they're well ahead. Operating margins too. They've steadily climbed from below 20% to a 24.3% 5-year average. And they're actually targeting over 30%, which frankly elite for this sector. And maybe the best indicator of core profit, return on invested capital, ROIC. Consistently superior returns there too, a 22.1% 5-year average.
And again, that tax benefit nuance for FY24. We need to remember that, right? How should listeners think about that when they see metrics like net profit margin or return on equity for that year?
Yeah, it's a really important flag. That one-time tax benefit definitely boosted their GAAP numbers, the official accounting ones. Net profit margin hit an incredible 81.0% for FY24. Return on equity was 68.0%. Looks amazing. But metrics like operating profit margin and ROIC, those strip out the one-off stuff. They give you a much more accurate, more reliable picture of their core, ongoing operational earning power. Helps you see what the business actually earns day to day, not just what gets inflated by a temporary accounting thing.
Right, clarity is key there. So overall, profitability gets a perfect 5-star rating, a 5.00 score. It's really, like you said, a textbook case of operational excellence. Okay, next up, financial strength. The report uses words like impeccable, fortress-like balance sheet. What makes it so strong, and what does that mean for them strategically?
It's an amazing position to be in, really. They have a huge net cash pile, over $1 billion as of the last 12 months. And debt, it's negligible, less than $20 million total. And crucially, they generate powerful free cash flow, enough to easily fund their capital spending, dividends, share buybacks, and still have cash left over. Essentially, they can pay for their own growth and return cash to shareholders without needing to borrow or issue more stock. Huge flexibility.
That sounds incredibly solid. What about their specific ratios, like liquidity, solvency? How do those compare to others in the industry? Are they just sitting on a mountain of cash, like having a fully stocked pantry before a storm?
That's a perfect analogy.
Yeah.
Yeah, their current ratio average is 4.8. Quick ratio is 3.9 on average. These are exceptionally high. Industry norms are usually more like 2.0 to 3.0. So yeah, they have absolutely zero short-term funding worries. And solvency. Leverage is basically non-existent. Debt to equity, debt to EBITDA, they're practically zero. Supreme solvency. And the interest coverage ratio, it averages a massive 173x, meaning operating income swamps their tiny interest expense. They are definitely ready for any kind of market weather.
Wow. And how do they handle capital allocation? Are they sharing that strength with shareholders?
They absolutely are. They've got a solid multi-year track record of increasing their dividend. The compound annual growth rate on that dividend is over 25% for the last 5 years. Plus, their payout ratio is actually very low, average 46.6% of free cash flow. That leaves tons of room for future dividend hikes, buybacks, or strategic moves.
Okay, so wrapping up financial health. Another top-tier score. 5 stars for financial strength, 4.9A numerically. Just pristine financial health, giving investors a substantial margin of safety. All right, let's shift gears. Let's talk about how the market sees MPWR, starting with the sell-side analysts. What's the general feeling there?
Well, what we see is a decidedly bullish view overall, a strong consensus buy rating. The average brokerage recommendation is 1.57. Remember, 1 is strong buy on that 1 to 5 scale. And a big chunk of them, 11 out of 14, or you could say 89% of the 19 analysts covering them, rated either strong buy or buy.
That sounds almost unanimous, but the report mentions a wrinkle here. This positive view seems, well, baked into the price already. What signals that analysts might be in a wait-and-see mode despite the high ratings?
That's the key tension, exactly. Analysts clearly like the company, the story. But the fact that estimate revisions have kind of plateaued recently suggests they're waiting for the next big catalyst. For example, over the past month, there haven't really been net upward revisions for FY25 EPS that's still around $17.08 to revenue, around $2.67 billion. Pretty flat. And the upside, if you look at the current price, say $720, and the average 12-month target price around $785, well, that's only about 8–10% upside. That doesn't exactly scream deeply undervalued, And even though MPWR almost always beats quarterly EPS estimates, the size of those beats has gotten smaller recently, more like 1–2%. Suggests analysts are getting, better at modeling them. The element of surprise is shrinking.
Okay, so pulling that together, the analyst sentiment gets a more neutral rating. 3 stars, 3.3 numerically. It sounds like, yeah, well-loved, but also very well understood by the street.
Precisely. It feels like it probably needs a significant positive surprise, something unexpected, to really move the needle on the stock price from here.
Yeah.
From this analyst perspective, it really seems to be about valuation.
Right. Now let's zoom out even further. Sentiment from news, general investors, traders. The report points to a uh, fascinating divergence here.
It really is quite telling. News sentiment, it's generally positive. You see lots of focus on those AI and auto tailwinds, the strong earnings, but it's balanced. You also see reports about recent stock pullbacks, profit-taking in the sector. So it ends up mixed, but net positive. Tip ranks, for instance, shows it pretty much 50-50 bullish-bearish in recent news.
And what about the general investor buzz, like social media, forums? That seems pretty bullish, doesn't it?
Oh, very much so. You definitely see a lot of optimistic comments, people adding it to watch lists, that kind of thing. Quite positive sentiment there.
Okay, but then we hit this sharp contrast, the traders. What are their indicators telling us, and why might that be so different?
Yeah. Yeah, that's where it gets really interesting. Maybe even a bit counterintuitive. Trader sentiment indicators are pointing more bearish. Most significantly, short interest has jumped recently, up nearly 22%. It's now about 5% of the stock's float. That's not insignificant. People are betting against it. And look at the options market. The put-call open interest ratio is 1.33. That means there are substantially more open bearish put contracts out there than bullish call contracts. Now, the likely reason for this isn't that traders think the business is bad. The fundamentals are strong, as we've discussed. It's more likely a bet, a wager, that the valuation is just too high, making the stock vulnerable to a pullback or correction. It's like smart money versus the general street view almost.
That really is a stark difference. So for broader market and news sentiment, it gets a 3-star rating, 3.22 numerically. Mixed definitely shows that divergence. It really sets MPWR up as a classic battleground stock, doesn't it? This divide between fundamentals and valuation positioning.
Okay, so let's pull this all together now. The final overall company fundamental rating. Now, this rating, it combines those core pillars we looked at: growth, profitability, financial strength, but specifically leaves out the sentiment stuff, the more ephemeral market indicators. The idea is to get an unbiased view of the underlying quality of the business itself.
Exactly. And that final score, it's a top-tier 5-star rating, a numerical score of 4.58. Identifying MPWR as, well, a fundamentally elite company, its core strengths, as we've hit on, are that exceptional best-in-class profitability, driven by their unique chip design and that incredibly strong fortress-like balance sheet. It really comes down to their technological innovation and integration. That's what built this durable competitive moat they have. And the growth story, while maybe not the hypergrowth of the past, it's still really formidable, isn't it? Anchored to those huge secular trends, automotive electrification, AI infrastructure, that gives them a really long runway for creating value in the future. So what does this all mean for you, the listener, thinking about this company?
Well, from a purely fundamental business standpoint, Monolithic Power Systems is, without much doubt, one of the highest quality companies you'll find in the tech sector. The core debate, the investment question around MPWR right now, it's not really about the quality of the business itself. That seems unimpeachable. It's much more about the valuation, about the very high expectations that seem to be already baked into its current stock price. It's a classic case of a great business, but one that many feel is priced for perfection.
It really is a fascinating picture, that stark contrast. Undeniable fundamental strength on one side, and this cautious market positioning, mostly driven by valuation concerns, on the other.
It truly is. And maybe that leaves us with a final thought for you to mull over. Given MPWR's 5-star fundamentals, but this mixed market sentiment that's clearly focused on the high valuation, how do you personally weigh that? How do you balance an indisputably great business against expectations that might already be sky high? Does exceptional quality always justify paying a premium price, or does the market inevitably demand new positive surprises to push a stock like this higher? Something to think about.